Okay, kids, this is Uncle Pete's Wall Street. I'm Uncle Pete. Welcome back. Today, as you can see on your screen, you're probably wondering, what is this? I remember, Uncle Pete, you mentioned Louis Rukeyser in a previous video. Yes, that video was Who are the two men that changed my life? One of them was this man, Louis Rukeyser, who was the host of Wall Street Week with Louis Rukeyser on PBS. And the reason I wanted to bring him back up in today's video is because of the correction we've been having in the market recently. And Louis Rukeyser, in addition to the show that he had on PBS, um, he had newsletters. One of them was just called Louis Rukeyser's Wall Street. The other was called Louis Rukeyser's Mutual Funds. And I subscribed to this newsletter. And the one I have here is one of the oldest ones I was able to find in my boxes and bins that are in my closet. Um, it's from February 1994. And you're probably asking, why would you bring about what is a newsletter from February 1994 have to do with today in 2025, March 2025? Well, one of the things I loved about Louis Rukeyser was he had a calming effect not only on the overall markets when they went haywire, but also on the people who watched his TV show and read his newsletter and listened to his commentary, right? Because the the natural thing to do when the markets get crazy is to, oh, that's it. The world's coming to an end. Let me sell all my stuff now, sell all my stocks, all my mutual funds, and run for the hills. Well, he was the kind of guy who could talk you off the ledge. And I thought it would be good if I read his opening commentary in his newsletter from February 1994. Okay, this one's entitled Buckle Up and Hold On for the Long Ride. And this is what Louis Rukeyser wrote. One of the reasons many people haven't been making the money they should have in a stunning bull market like this is that they persist in asking the wrong questions. They want to know, for example, exactly when the next sell off is coming and precisely how bad it is going to be. There are only two problems with those recurrent questions. Number one, nobody really knows the answers. And number two, the woods are full of charlatans more than willing to pretend that they do. The names of those charlatans change from time to time. After a while, people do wise up to perennial error. But there's always a new crop eager to claim the discovery of a wonderful new system that enables them flawlessly and superhumanly to tell you precisely what is going to happen and when to every market from titanium to tadpoles. All this would merely be amusing, a gory diversion from the humdrumness of real life here on earth, if it didn't frighten so many innocents away from the profits that are aching to be made in the stock market. One sad proof is that even today, though the market has moved steadily upward for the longest uninterrupted period since the invention of the abacus, the percentage of U.S. household assets in stocks, including mutual funds, is way below what it was 3 decades ago. Plainly, the gloomsters can be poisonous when it comes to a subject on which most people are already naturally jittery. The fellows telling you it's time to cash in and get out will always get more media attention than the ones whose advice genuinely makes people money. But could the market now finally be getting ready for a significant correction? Sure, it could. As the inimitable John Templeton points out in the Rukeyser interview this month, and as Peter Lynch reminded us a month ago, bear markets happen, but the wise investor will regard them as buying opportunities rather than selling panics. As for timing, the market so as to be in cash, as for timing the market so as to be in cash when the market tumbles and fully invested when it climbs, good luck. Just because nobody has ever actually been able to do this with any consistency throughout human history doesn't have to mean that you won't be the first, does it? Or you might prefer to act like a grown-up, in which case the answer, it seems to me, is simpler, if perhaps less initially arresting. Certainly, it's okay to lighten up a little after a long market run, but don't try to be, as the British Riley put it, too clever by half. Basically, the way most people are going to make the most money in the next decade is the way most people have traditionally made the most money in investing, by finding quality stocks at reasonable prices and then holding on to them through the hysterical fluctuations of the marketplace. Lest this just sound like a truism, let me cite a specific instructive example that arose in my interview with John Templeton in these pages exactly 1 year ago. Templeton's great knack over more than half a century has been his ability to find the securities anywhere in the world that have been beaten down by too much pessimism, or as he likes to put it, with characteristic simplicity, bargains. Last February, he told us that one of those he had spotted was National Medical Enterprises. The stock, then around $10 a share, was beaten down to $6.50 as the negative news continued. At which point I heard from a few disgruntled readers who wondered why I thought this Templeton guy so great. But those who hung in there have been spectacularly rewarded. The stock was recently trading around 15. When the price is right. Now, clearly, one abiding lesson of this experience is that successful long-term investors really do have to practice the patience that Templeton preaches. But when I reminded John the other day of this remarkable one-year performance, he wasted no time crowing, but instead voiced an additional lesson worth remembering. Quoting John Templeton, "The lowest price occurs at the time of maximum pessimism. With the price of the stock up, it would not be one of the very best bargains today." End quote. And so, since I suspect that, like myself, you are more interested in solid wealth than spurious wizardry, our emphasis in this newsletter will continue to be on what I strongly believe will be the most important single tool in the 1994 financial markets. Careful selectivity in choosing your investments rather than idle speculation about short-term oscillations. For the longer run, I remain unfashionably convinced that stocks are going to be surprisingly rewarding investments over the next decade. We have many and well-known problems, but America and much of the rest of the world are finally getting their economic acts together, with greater efficiency and less inflation than seemed probable even 10 years ago. It looks to me like one of the most exciting periods in human history, and we'll be doing our darnest each month to assure that you keep getting the authentic information you need to be among its biggest winners. From 1994. And I was listening to Mr. Rukeyser back in 1994. One thing was for certain is that Louis Rukeyser had the wisdom of his years to know that the place for long-term investors was the stock market. Now, me personally, I like index funds and index ETFs, particularly the S&P 500. As I've said in many videos previous to this one, I have been investing for 30 to 35 years in the Vanguard Index 500 mutual fund. It's been around since 2000, but prior to that, I was invested in individual stocks when I didn't know what I was doing, and then finally in mutual funds when I started working back in the stock market in 1998. I invested in mutual funds, an index mutual fund in my 401k. And I continue to invest in the S&P 500 mutual fund, particularly Vanguard's mutual fund. So we're in a rough spot in the market right now. It's very volatile. Any piece of news on tariffs sends the market either up or down, depending on what that news is. But when it comes to long-term investing, don't try and time the market. Your long-term retirement plan is just that. It's a retirement plan. You're not supposed to touch that. Remember, you're dollar cost averaging. You're putting the same amount of money in your account each month. So when the market corrects, your mutual fund, your ETF, the price of your mutual fund or ETF is going to be less. So you're going to be buying more shares, right? And when your mutual fund or your ETF pays a dividend, it's going to be buying more shares because the price is lower. This is how you build wealth. You stay the course, right? Let the fools sell when the market is down. Because what are they going to do months from now when the market is up? That's when they start buying again. And they go into this perpetual revolving door of buying when the market is high and then selling out of fear when the market corrects and the market is lower. And they never make any money. They just keep losing money. They're in an endless loop of fear. Greed when the market is up, fear when the market is down, and their finances become a mess. Okay? So I hope you take Louis Rukeyser's words from February 1994 to heart. Okay? It did me well. It did me very, very well over the years by listening to this man, staying the course, continuing with my dollar cost averaging when the market was down, continuing with my reinvesting dividends when the market was down, and throughout my investments. All right? I hope you got a lot out of this video. This is Uncle Pete's Wall Street. I'm Uncle Pete. I will see you in the next video. Good night.